Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Crillo. Today we have Manish Pushye. He arrived in the US in 2000 with only $700 and an engineering degree, and has since built a diversified portfolio across industries, including hospitality, retail, wholesale, e-commerce, IT, and manufacturing. His company, Awesome ROI, and their 72-person team acquires hotels, apartments, and shopping plaza, focusing on a strong cash flow and equity growth. So Manish, thank you so much for coming on the show today.
Hey, thanks, Charles, for having me. I appreciate it.
So you have an interesting background prior to getting involved with real estate. You're an entrepreneur in many different industries. So tell us a little bit about yourself, both personally and professionally, prior to really launching Awesome ROI and start launching your own funds and buying real estate.
Oh, yeah. So, Charles, I came to United States in the year 2000 with hardly $700, and I came as a Y2K on a Y2K project as a software engineer, and Y2K came out to be dud. And after like 3 or 4 months of landing, and working on one project, I was told, like, you're out of job, you have no job, and I'm like, wow. I didn't see any of that back home. Like, you are given 1 day and you're given a pink slip and you're told now you're your own and you can do whatever. And I'm like, wow, so should I go back or should I try so I did try for a month or two to get another project. Didn't happen. So that's when one of my friend was doing a cell phone business in one of the shopping mall. I went, joined him in Oklahoma City, and I was in Boston, Massachusetts at the time. So from Boston to Oklahoma, quite a transition. But as I said, when you are fresh on board, and you FOB, you don't care about where you're gonna live. You have ambition. You have taken loan to come here, and you have to pay those loans off. Those are the agenda you have in your head. So I went to Oklahoma, I started working with him, and at one point I realized I can do it myself. So I end up starting my own kiosk in one of the shopping mall and end up having 28 kiosks at one point. And, that's how I started my entrepreneur journey. And after that, business after business, I have done like 23, 24 different businesses. And now I'm at the point where I can look at any balance sheet or profit and loss, and I can tell you whether this business is worth your time or not. So that's my journey.
And how did you get involved with choosing real estate as really your investment vehicle, being in so many different industries that we touched on in the intro?
So I have done a lot of businesses, from e-commerce, as you mentioned in your opening statement, from e-commerce to manufacturing, retail, wholesale, distribution. And when I was doing e-commerce business, I was making good money. I was making like 9-figure at that time. I'm talking about 2015, 2016. And I was like, how should the money I'm making, okay, either I can add more products or launch new products, or I should do some kind of investment on the side, which is, going to be a generational wealth, correct? So those were my choices. And I realized it's better if I go for real estate. And, as everyone else, I started with a single family. That's how you start, right? With creative financing. Like I was doing seller financing and sub to. At one point when I was doing my e-commerce, I was buying one single family house every month or every other month, and I kept doing that. And you start with single family because your main niche was e-commerce. This was just an investment thing on the side, the real estate. But I was buying properties and I was renting it long term, not any short term. I started doing short term later. And at one point I realized I have like 12, 15 houses And, it came from, and I have no idea how it happened. And then I started seeing my rental income becoming like a real income, to the point of like 25 grand a month. Then that's when I started taking it seriously. And I'm so happy I did that, because then COVID came, and COVID really messed up my e-commerce business to the point it didn't recover even today. Um, and I was able to acquire businesses such as liquor stores and convenience stores and laundromats. Uh, if I did not have these real estates or these single family residences 2025, I don't think I'll have any capital to acquire any businesses. And there comes a time in your life when you fall from such a height. Like I'm saying, in e-commerce business, I fell from like such a height that I did not have even income or money to pay my bills, because the containers were not coming from Asia, and all my products were based out of Asian suppliers, and the containers were not coming. At one point, like 3 or 4 months, zero container, zero supply chain. I could not even, and I did not get money from Amazon, didn't get money from Walmart. I was selling on those two platforms. And that's when I realized I have to have diversification. I cannot rely on one business. That was my wake up call, to be honest. And that's when I acquired first liquor store in Mesa for 4.2 mil with zero out of pocket. How zero out of pocket? Um, 75% was seller financing, and the remaining 25% I acquired from my assets, which were almost had ton of equity in them. And there was a lender I could find who gave me money against that, and that's how I started my first liquor store. And now, fast moving 5 years down the road, 2025, I own 7 liquor stores and a couple laundromats and other businesses and commercial real estate. Yeah.
So when you're talking to entrepreneurs, because this was similar when I got involved and bought my first multifamily property in 06, I was running an online business right out of college, during college. And then this is after college when I bought this. And, it was taking some of that capital, some of that profit off the table and putting it somewhere else. Is this something that you would suggest to really any entrepreneur that has a business that's starting to make money? You know what I mean? Not only put back into your business, because there's a great kind of little bit of a gray area. Obviously, real estate can be very capital intensive out of your own capital if you're not, like you're utilizing creative financing. But is that a smart thing to do with people maybe spreading between building their business and investing into something that's really not really correlated with what they're doing over here?
I advise everyone, every new or, whenever I see some young new entry comers, those who are about to begin, they launch their career in corporate world, I tell them, you have to have something going on, and you should be making at least 150 to 200K a year to pay your bills, to pay, your expenses, day-to-day expenses. You cannot get into real estate thinking this is going to be your bread earning income, like you're going to be paying your bills with the real estate solely based on the real estate. You have to have either a business, operating business, that's taking care of you. Like in my case, I cannot now. I can. I mean, if I have to just rely on my real estate income, yes, now after 10, 15 years. But to start with, I don't think I can just rely on real estate income, no, or the rental income or the money you make from the real estate investments. I don't think so. You have to have an operating income, operating business of any sort. In my case, it was an Amazon, e-commerce business, and then later on all these liquor stores or laundromats, or in fact, check cashing, lot of businesses. So those were taking care of my day-to-day expenses, my debt, because when you acquire this business, you do creative financing. At some point, you have to pay those
Pay
dues,
back.
right? And it's not like creative financing is like all creative; it's all in air. No, you have obligation. You have to make those debt payments. So those things are all taken care by my businesses, not by my real estate. Around real estate, yeah. Now I have one shopping plaza which pays me 1.4 mil a year in net income. After, I mean, it's triple net. So now I'm at that stage, I can say, okay, I can rely on real estate. But to start with, I don't think I will advise anyone to jump into real estate thinking they can rely on that income. They have to have some job or some operating business in place, uh, and they should do this thing on the side. you know this should be your side hustle, should not be your. But I mean, I don't know, maybe I hear people are doing all kind of warehousing or wholesales and flipping and all that. They are making good income. So I mean, I'm not saying, but in my case, I had operational businesses and this was a side gig to start with.
And when I started investing in real estate, one thing I found, and there's different between, if you're talking fixing and flipping, I see that more as a job, as a business, whatever you want to call it. It's like you would call it an operating business. It's something where it's a 60 hours plus a week type of thing. I mean, you're hustling even more, and 7 days a week. And I see that as a regular operating business anywhere to be successful today. But when you're going into what we're kind of talking about, the other one, which is kind of like rental investing, where you're buying, we're buying commercial properties, we're buying larger multifamily, whatever it might be. I think when I started investing, I saw people that were, wealthier, people that were maybe not, the people that had successful businesses, right? And what they were doing is they were taking some of their money. They were attorneys. They had their own firm. They were putting money into real estate. They had, they're buying apartment complex, small apartment complex, one after one. And then they were, you see other people that are running restaurants or whatever, and they're taking money off the table and they're putting in the real estate. And if you speak to any kind of old school investors that have been doing it for many years, there's always something behind it that they're kind of utilizing for doing it. I think if someone wants to go, oh, I'm quitting my job, I'm going to rental investing. Well, it's really difficult. I mean, just in your first year with buying a rental property, it can usually be difficult to make money because you're putting there's no cash flow for the most part. That's the reason why when we start distributions, it's many months, many quarters down the road, because we're just like getting stuff up and running and making a lot of changes. That's where the value comes in. So like you're saying, yeah, you got to have stuff taken care of, and then you can take a little money off the table and put into something that's not really correlated, which for you was really your insurance policy during COVID.
Correct. And the other thing I advise everyone, have diversification. Like nowadays, multifamily has its own challenges, and I'm glad I'm doing several different asset classes, from shopping plazas, strip centers, to hospitality, to RV parks, to business acquisitions, you name it. I mean, I have a team of 72 employees at the moment, and they are my whole soul caretaker of I love them to death. I mean, without my workforce, I don't think I'll be sitting and chatting with you. I mean, it's not going to be possible at all, right? I mean, they are the ones who are, and I express this to them. I tell them, without your contribution, there's no way I can do what I'm doing. So I sincerely appreciate all what you're doing for the company. And so I'm blessed to have the workforce, the team, and my family, honestly, because it's not easy for someone who's super ambitious to be handled by my daughters, my wife. They have to they have to cop up a lot to see, like they are flying to India today, and I have to go after our a podcast. I have to go drop them to the airport. But what I'm trying to say is, it takes a village. to do where you at. I mean, you should not forget like how many sacrifices, how many people it took. And I tell all my employees, when the time comes, I want to pay you back in some way or shape, especially the employees who had given their really everything to my company.
Yeah, with so many different asset classes and really businesses you're involved with, having a team like that is really imperative to be successful on all fronts. But kind of moving forward to what you're doing now, let's talk about your current real estate investment strategy and kind of what you're doing with the Awesome ROI Fund 2 and kind of what your business plan is there, because it's multifaceted with stuff you're involved with.
Yes, so Awesome ROI is a 506C Reg D fund, and we are raising 50 million in equity. The total projects is almost 150 mil. We have too many projects lined up from strip center, shopping plazas, and this is the first shopping plaza I'm entertaining. It's with a big anchor called Food City. Otherwise, usually I try to stick to smaller strip centers with not main anchor, because my concern is, what if they live and they are your biggest tenant, and how hard. I haven't tried it. This is the first project I'm doing in Phoenix. It's a 15 million ask. I'm trying to negotiate it to 13.5, and it's going to be a 12 cap. And that's another thing, Charles. I try not to get into things where it doesn't make, I can pencil a deal. The deal should be easy to pencil. It should make sense for my investors. It should make sense for myself, because I'm so busy. I don't want to spend time on something just to prove my name. That's not my style. And and the other project I'm doing at the moment is acquisition of a DoubleTree hotel here in Gilbert. And I'm not doing much of hotels unless I see some upside to it, or some value add. Upside to this is there's a 10,000 square foot conference center, with this hotel that comes, and it's very underutilized. And one of my friend, she owns a banquet center in Phoenix, and she's doing phenomenal. And when I checked her banquet, we go to her parties every now and then, to her center, to her conference place. And when I saw this one is as comparable as hers, and she's doing like 7 to 8 mil, and this one is hardly doing 750K a year. So it's very underutilized. So that was one big reason I wanted to acquire this hotel, because it comes with a conference center and a liquor license, bar, and the bar closes at 5 p.m. Who closes the bar at 5 p.m.? So those are the factors, I really put a LOI into this deal, and it's been accepted. Now we are about to get into PSA stage. We are looking for the capital raise and the stacking and all that. So those two projects, and then there is a RV park. It just came. It's in Arizona as well. So there are a ton of, and business acquisitions I don't even count, because I keep doing it now. It has become, as I said, if you tell me any business, I look at the P&L and I can tell you whether it's worth our time or not.
Nice. So I kind of want to drill down into the small plaza strategy that you're utilizing. That's something that we really haven't spoken about much on the show, and I'd love to give that overview to our audience. So other than having pretty much, for lack of a better word, really all your eggs in one basket with a larger plaza with that national chain tenant, which can be difficult to attract, right? What are your kind of thoughts on why small plazas are superior to those larger ones?
Well, small plazas are very easy to handle. One, they both are triple net. Triple net is the name of the game. You don't have to worry about maintenance. You don't have to worry about taxes, insurance, or HOA, all that. In fact, in this holiday period, all my plazas, we put the lights and decorations and all that. That also came out of our tenants' pocket. We didn't invest even a penny. So, you don't have to worry about any kind of plumbing or maintenance issues or electric. It's all taken care by them. They don't call you for, and who doesn't want to have those kind of acquisitions? So triple net is the name of the game. And when it comes to smaller strip centers, it's easy to manage, easy to handle. And when it comes to the big anchors, they have a lot of demands, and they really put too much on their leases. I have a friend who own a Sprout. I don't know if you know their grocery chain here in Arizona. We have a Sprout, and Sprout left, um, and now he's struggling to find a decent tenant for that space, and that rent was almost 65 grand a month, and now he's really having a hard time. It's almost 12, 13 months. He's
$800,000.
yeah. So I'm not against that. Having big shopping centers with big anchors or big tenants, but I'm not there yet, and I don't want to be a place where I really struggle, or when I'm doing good with the smaller strip centers. And the other thing with my strip centers, if somebody leaves or somebody is not paying on time, I'm happy for them to leave, because I'll bring my own concept. It depends on the demographics or the area that plaza is. You can either, I know how to start a liquor store or convenience store or laundromat or restaurant, you name it. I'll put my own business, so it's easy. But when it's a big anchor location, what I'm gonna do there? I mean, the best I can do is a nightclub or some kind of dance club, but there's not much I can do with those spaces, right? But with the smaller spaces, I know I can do my own businesses.
Yeah. The thing that happens too is if you did put a business, I would imagine that wasn't a solid nationwide anchor tenant in there, like that Sprouts, or down here in Florida in the Southeast, we have Publix, and it's one of those things where once you put something else that's not that in there, I think it would really pull down the value of it, because that we're banking on this anchor tenant to pay the rent when they're in there and to stay and run a business, stuff like that. And when they leave, or if they weren't, if you put someone else in there that maybe is not as strong as a tenant, let's see, in the eyes of a buyer, that's gonna drive up your cap rate type thing, and it's gonna really kill your value.
Yeah, so I'm not against those kind of proposals, but I'm not there yet. I want to be very secure. I want to play safe, bottom line.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carrillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So one of the things I found when I've had people, large retail, the Plaza shopping mall guys on the show here, and it would be one of the things is that they would have there's a lot of work that's done in the sourcing of that large national tenant. I mean, it's not something that's a very simple thing to do. But let's talk about when you're sourcing tenants for your small retail in your target markets. I mean, how do you usually do these deals? Obviously, your backup plan, I would think, is putting in your own business, which is a great way of doing it because you can sell that and you can do whatever you want with that afterwards, maybe sell it. And now you've got a tenant there, a business that's running, all that kind of stuff. But how long are these leases typically when you will, rent out a place in small retail? And, how does that really differ? Or how is that all structured, I guess I would say?
So most of the leases are 5 plus 5 plus 5. I mean, most of the tenants, they go for 10 to 15 years because if they are coming, they want to be a long-term player, right? Because they are going to do so much on advertising for their own business, and they are going to be, working hard to, bring business to themselves. So they always come with 15-year leases in mind, especially I have not seen any of my tenant less than 5 years. And on average, I'll say 10 years is pretty average. And when they come, other good thing is we are 3 to 5% annual increase, which is not a bad thing, right? I mean, and it used to be 2.5. Now with the inflation and all that, it's 3 to 5% annual increases. And on top of that triple net nature of this business, which is awesome, and you don't have to worry. And then in my leases, if I don't get my rent on the 10th of every month, there is a good penalty for those tenants. I mean, and if it happens 3 times in sequence, then I have the right to basically tell the tenant or give them a warning or tell them to leave. That's a kind of a nature of this businesses. And on top of that, Charles, you won't believe if these businesses sometime they are struggling, they tell you, I have this once or twice, they ask you, or they have some kind of a death in the family, or they basically tell you, we don't want any money. Can you run our business? I have got 2 such businesses for free, and not free, but I told them I'll pay them some royalty, because I want to take advantage of them. But it happens. So, like sometimes things are out of control with the operator, and there's some kind of life-changing event, and they want to get out, and they know they cannot sell it in short period of time. There was this one immigrant dude, he got deported, and his family could not operate that restaurant. So we have to manage. The good thing is it's a lucrative business. It turned out to be a good deal for us, and we are taking care of his kids who are still here. And we told him, if your kids, when they're grown up, they want to come work, we don't mind giving them their business back. We are not here to take advantage of the situation.
Yeah. No, that's great. That's great to hear. When you're saying, one thing just for the audience listening is, when you're saying your 3 to 5% increase, now that people might say, well, I've got rental housing, I've got apartment, whatever it is, and I'm raising a 3 to 5. You have to think too, with this business, the maintenance, the taxes, insurance, which we saw jump up dramatically, is taken care of by the tenant. So this 3 to 5% is on something that Nish probably already has fixed debt on the property, fixed financing. The property isn't going up. He's not paying more for it every year. So pretty much that's really going right into his pocket for the most part, right? So much different when we do rental housing. We're doing that really to cover a lot of our expenses going up. And we're getting a little bit more in our pocket. However, the majority of this, if not all of this increase, is going into your pocket. So that's a very big differentiator between multifamily rental. Yeah.
Yeah, it doesn't go to my pocket, but let's say the insurance every year is increasing like crazy nowadays. But I will not be stressing out because I know it will be taken care by my tenants.
So let's talk about how you source these deals. You talk about having a lot of unique deal flow. This is a unique business of finding these plazas. Obviously, you're very well versed in in these communities. You're very geographically focused in this certain areas of Arizona, which all these things are giving you a leg up and understanding the businesses intimately that you're renting to. Can you tell us how you source these? This is all word of mouth, it sounds like.
Oh, so I don't know. One thing I realized, if you close one or two deals, these brokers or the sellers, they find you from CoStar or Crexy or all these sites, and they contact you. And when they see the kind of play, because they can, I mean, it's a public record, they can see everything, anything, what price I bought and how much, and how did I close the deal, whether it was a creative or LTV or SPA or whatever. And then they call you and they expect you to do a similar deal what they have to close in the similar fashion. I'm like, okay, send it my way and I'll look into it and we go from there. And then, the other good thing is, even most of the deals I have closed is like a guy next door. He has seen me and he doesn't want to go through broker because he doesn't want to shell a big commission fee or whatever. He contacts me. He's like, hey, you remember me? I'm like, no, I mean, did we met? And he's like, I'm your next door neighbor and I have a similar parcel. Can we talk? I'm like, yeah, send me my way and I'll look into. So when you do certain asset class, those brokers and the sellers, they come talk to you, they call you. And so it's word of mouth in a sense. You don't have to run. And there are times when I'm looking for deals, I go find out from all these CoStar, Crexy. I have a CoStar. I'm paying them like $2,000 a month for their insights and their comps. And it's a beautiful tool for the CoStar. It does a lot of my underwriting. It makes my life so easy because it provides you all the comps for that area, for that zip code, and what's going on and all that. I'll advise, if somebody is getting into a commercial real estate, they should entertain this CoStar tool. It's pretty lucrative.
Yeah, and you can do it if you don't want to spend the $2,000 a month. Work, speak to other people, other underwriters that might have access to it. Years back, one of my partners, he was one of our underwriters previously. He would have like 5 different underwriters, and they'd share part of it. You know what I mean? So they could utilize it different time for pulling reports and whatnot. But so as we're kind of wrapping up here, one thing that you brought up before when you're telling us about you got here in 2000, how did being an immigrant really influence your perspective on kind of being a successful entrepreneur?
Charles, most immigrants come with the more ambition than resources, right? I mean, they come with this, you don't have a safety net. You don't have any idea how it's going to be. Everything is hit and trial. The most important thing I've seen in the immigrant community, and especially I have seen in myself, I respect each and every dollar to the point, if even today, after 25 years living here, I'm very conservative in my spending, my expenses, and that's how I treat my investors' money. I just don't, I sincerely respect their hard-earned money more than my own, because one, your name is intact, and you don't want to play with anybody's money in a way. And that thought process that you have to value for each and every dollar has really taken me to places I've seen. I'm not saying like everybody is reckless with the dollar or with the money, but after a couple of years, I've seen my own friends who came as an immigrant. They go easy. They're like, it's $500,000, right? I'm like, dude, $500,000 is still heck of a money. And so my point is, I still respect dollar to the point, I think 100 times before I invest here or there, and that's one thing. And then second important thing is resourcefulness over resources, right? We immigrants don't have a perfect network. We don't have perfect English. I mean, you can see from accent, right? Perfect credentials. So everything we have to do it in a way. We have to solve each and every problem in an ethical way, with creativity and with the relationship, with persistence. That's why, if I go to any company or somebody show me their P&L, I look at it and I can tell him then and there whether it's worth their time or not, because I've done so many closings in my life. And every closing now I know all the skills, but in the beginning, I used to wake up in the middle of night and I do my numbers crunching again, and the next day again, like I want to be 100% solid that this deal is going to be good. But after these many years, now, as I said, look at the numbers, whether you give me any P&L, I mean, I'll do my underwriting, I'll do my own projections and all that, but looking at it, I can tell you. And it came through practice, it comes through humble beginnings. And, at one point you are so humble, you are scared of losing your hard-earned money, and you do your homework again and again and again, repetition. And that's the important thing. And then the third most important thing I consider is long-term loyalty and community, right? If you are taking your investors' money, you have to ensure that their money is, or their principal is going to be preserved, secured, and they will get their principal, whatever the situation is. And second, you have to under promise and over deliver. So I don't tell them, give me your money and I'll double it in 2 years or 3 years. I mean, if it happens, good for them, good for me. But I don't show them the rainbow that or some kind of promises. But it happened eventually that my investors, they end up getting good returns. Like this 1031 exchange investor, he ended up making 33% annualized return. If it happens, good for everyone, and now he's thinking of reinvesting with me. So what I'm trying to say is, you don't have to push if you have the skill of working hard and you have done your due diligence, deep due diligence, and the deal makes sense. It will sell by itself. You don't have to push for it.
Well, Manish, this has been a great masterclass on buying real estate and buying businesses. And I want to see if you can tell us how our listeners can learn more about you, your business, and your offerings at Awesome ROI.
Yeah, Charles, thank you for having me, first of all. And it's nice chatting with you. And hopefully we'll interact more in near future. So Awesome ROI is based out of Phoenix, Arizona, and we do all our deals here. Our email is deals at awesomeroi.us. I have a awesomroi.com domain as well, but the email is awesomroi.us, deals at awesomroi.us. The reason being, I want to stress that we are United States based and Arizona based company. We are not doing businesses anywhere. And all our businesses are mainly in 50 to 80 mile radius of where I live in Peoria, Arizona. And, they can Google it, ChatGPT it, Awesome ROI, and it will take them to us. So that's how they can reach us.
Okay. Well, thank you so much for coming on today. We will put those links into the show notes, and looking forward to connecting with you here in the near future.
Hey, thanks, man. I appreciate it.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.